So how do you determine what is actually right for you? Well, this is going to come down to your needs, your wants, and your current set of circumstances. So the important factors to consider will basically be around the interest rate type, the payment structure, your loan term, your loan type, as well as the features and also the fees. So these are the things that you need to take into consideration, and ones that we'll walk through with you now. As we've discussed previously, interest rates are the lever that the Reserve Bank will pull up or down to keep the economy in check. Now, the RBA meet on a monthly basis and review the numbers across a broad range of economic factors to determine whether or not they should leave them on hold or whether they should raise them up or down. Now, interest rates basically keep inflation in check. If inflation wasn't in check, then prices would go up. And then we'd be starting to ask our boss for more money to pay for these product price increases, which would then affect employment figures, which would then affect the government's tax base and decisions on how to distribute the funds, and it goes on from there. Anyway, interest rates are a pretty big deal and will have a huge impact on the cost of your loan and the term for which you hold it. So what's the better thing to do? Is it better to get a fixed or a variable loan? It's an ongoing battle to determine, what is actually going to be best, and truly it just really depends. It depends on you as an individual and your tolerance to risk, and it also depends on what's happening in the economy, both of which will have pros and cons. So let's take a look at that. Variable interest rates, look, generally they're going to be the most flexible and allow for, additional voluntary repayments without penalties. Also, many products will offer a redraw facility to, regain access to the money that you've previously topped up. Fixed interest rates, well, the biggest benefit is, I guess, the certainty of the repayments during that fixed period. This can be pretty useful when your commitments are high, if interest rates were to rise even further, then it could doubt your capacity to meet those additional repayments. So, it could be well worth locking in a rate if that was to be the circumstance. Be mindful, though, that penalties can apply to early payment on all or a portion of that fixed rate loan. These could be referred to as break costs, and in that if you're breaking the fixed rate loan contract. Now, these costs can be crazy expensive because although the loan may be repaid, the credit provider must still carry the cost of the loan until the end of the original fixed rate period. Now, there's also split or combination rate loans, and this is, I guess, the benefit of both worlds. This offering basically provides a proportion of the loan under a variable rate and the remaining proportion can be at a fixed rate. The advantage under this offering is the flexibility it offers under the variable component and the assurance it provides under the fixed component. It's a way of hedging your bets, I guess, so to say. Disadvantage is that, interest rates can still increase under the variable component, and if interest rates drop, and the component that is fixed will unfortunately remain the same. Split loans can be structured any number of ways, the most common of which is 50-50 or 60-40, depending on how you felt interest rates could fluctuate over the medium term. The decision between fixing and not is really down to your own personal preferences. And finally, the last thing that we'll discuss is the comparison rate. Now, the comparison rate will actually help you work out the true cost of your loan. This is the rate that includes the interest rate plus the fees and charges that relate to the loan. It is then reduced into a single percentage figure. For example, a bank might advertise a home loan rate at 5.55% per annum. However, when fees and charges are added in, the real rate could actually be 5.75% per annum. Now, credit advertisers must advertise the comparison rate. It's usually the smaller percentage located under the big bold interest rate number. Another thing to remember, though, is that comparison rates don't actually include government fees and charges and other charges and other changes, I should say, that cannot be determined at that point in time. It doesn't take into account the free product features like redraw facilities or fixed payments. Therefore, it's important to give consideration to the whole product that is actually being offered. Most loans are due on a monthly basis, but some, actually all, will pretty much allow for fortnightly and weekly payments. So instead of making one payment per month, if you look at fortnightly or weekly payments, then that amount will actually be divided by a half or by a quarter, meaning that if you choose fortnightly or weekly payments, you are actually paying an additional repayment each year by a whole month. This then reduces the loan term and therefore the interest that you're actually paying. Interest on loans are actually calculated daily. Means that you're going to be saving in the long run as well because of the additional repayments that you've been making. The more you pay off the principal, the less interest will be paid over the long term. Pay weekly, pay daily, pay whenever you can. The more you add on a regular basis, the quicker you will repay your home loan. Loan terms can vary in length. Generally though, they go up to about 30 years. 25 to 30 years is the most common loan term for residential property. This could change, depending on your age, the purpose of the loan, and your actual capacity to repay. Repayments on the loan period will either be principal and interest or interest only. For residential loans, most credit providers will only allow interest repayments for a maximum of 5 years. Some will go to 10, but majority is around about 5. P&I is by far the most common way in that interest is paid, and little is actually reduced from the principal, calculated over the long term, being that repayments will go for 25 to 30 years. Now that we're talking about loan terms, it's well worth bringing to your attention some risky products, and one that I think is pretty risky is 40-year home loans. 40 years, that's a really long time to have a home loan. You still could be making mortgage repayments in your retirement. It's really crazy. Think about how much interest you'll pay over 40 years. Now, sure, the initial repayment will be low, but that's because you won't really start paying anything off the principal until you're like 20 years into the actual term. There's also 40 years of economic cycles and dramatic changes to interest rates over that period of time. As you can see from this slide here, you're going to be paying, hundreds of thousands of dollars more in interest over, a 40-year home loan. So, whilst it could mean that you get into your property sooner because of the lower requirement for repayments, it could be a really costly exercise over the long term. But like all things, let me finish my rant, but give it some careful consideration. Scrutinize what's actually been offered to you, weigh up the options, and then decide whether or not it's actually going to be right for you. Home loan products can be packaged with features or simple no-frill type offerings. They generally distinguish between the features or their characteristics, which would include most of the things that I've detailed on this slide here, which would be the interest rate, the method of actually calculating the interest, being that it's variable or fixed, the portability of the loan, meaning that you're able to keep the same home loan even if you were to move homes. There's also the loan term, there's also the fees and charges that would be applicable. Redraw facilities, this is when you as a borrower have made additional repayments over and above your normal repayment, well, then you can re-access that by using the redraw facility. There's top-ups, which give you the ability to extend the credit limit on your existing loan. Or you could perhaps look at an offset account, which is another feature. This is where the mortgage account is linked to a transaction account, where the funds in the transaction account are offset from the loan account. Generally, it will reduce the actual interest that you pay if you actually have money within your transaction account. Numerous loans are available in all different shapes and sizes, all of which have been created to basically suit the individual needs of the borrower. So let's discuss, some of the more common products that are available on the market, and we'll go through each one individually to determine, what could possibly be best suited for you. Variable rate loans is probably the most popular product in the Australian lending market. The interest rate can vary through the course of the loan, either up or down, depending on what's happening in the broader economy. Now, the advantage of a variable loan that is, if interest rates drop, repayments will drop. Generally, extra additional repayments on the principal can be made without adjustment as well, meaning that the loan can actually be paid off faster as well. The disadvantage with this type of product is that if interest rate rises, so will repayments, meaning that larger payments are going to be needed. Also, it can be harder to budget when, market rates do fluctuate. So check out some of the comparison websites and see who's offering what, or even better still, contact the buyer's guide and we'll do the legwork for you and determine what is going to be the best variable rate out there for you. Fixed loans, on the other hand, now this is a product where you as a borrower can have the interest rate and the repayments locked in for a set period of time, usually between 1 to 5 years. Now, at the end of that period, borrowers can have the choice to revert back either to a variable loan arrangement or refix the rate for another set period. Look, the advantage in this type of arrangement is that it gives you, the borrower, I guess, certainty in how much the repayments will actually be. When rates rise, there's going to be a guarantee that the interest rate and consequently, your payments won't go up either. The big disadvantage is that if interest rates do fall, then you're going to miss out on that benefit because you've already locked in the rate. Also, it may not be possible to make additional repayments on the loan principal. Also, the fees and charges associated with changing from fixed to variable prior to being locked in period ends can also actually be very high. Capped rate loans is where the interest rate basically has a capped ceiling, meaning that the rate cannot exceed the ceiling during that period. However, the interest rate can move below the ceiling. So the rates are normally capped for about 1 year and then will revert back to a normal variable rate loan. The advantage of this is, if interest rates do increase, the mortgage rate will not rise above that set ceiling, thus giving you a degree of certainty. And if interest rates drop, they will probably fall in line with the market rates as well. The disadvantage of this product is that, generally they're offered as a honeymoon rate to new clients. Also, there isn't any guarantee that the variable rate the loan reverts back to will be any lower than the other banks. And there are exit penalties as well for early repayments. Now, a discounted variable rate loan is almost an identical product to the variable loan, except that it's discounted on the standard variable rate for a certain period of time, usually a year. It's what they call the honeymoon rate. Now, the standard rate decreases, so does the discounted rate by the same margin. Advantages though, the reduced rate often equates to lower repayments, with the borrower also having the ability to make additional repayments without penalty. The disadvantage of this product is probably the penalties for discharging the loan early. Generally within the first 5 years can be quite high. High start loans, this is where an allowance has been made for low initial repayments, which then increase over the loan term. So the advantage of this is that it's quite a good product if your earnings are low or you actually have large financial current commitments, but are basically expecting that your income is going to increase during the loan term. The disadvantage of this product, I guess, is that very little principal is, going to be paid off in the earlier years, meaning that, interest repayments are greater than the standard loan over the life of the loan. Also, repayments increase by a certain percentage each year, while your income may not necessarily increase at the same rate. Now, high start loans is basically the opposite to a low start loan, meaning that repayments will decrease over time. The advantage is that it's a good product for borrowers who have access to higher income in the early stages of the loan and are going to be able to reduce the principal earlier. The disadvantage is that, if there is a loss of income during those higher periods of repayment, there could be difficulty in, meeting the higher initial repayments. Split or combination loans basically give you the best of both worlds, meaning that as a borrower you can take a proportion of the loan under a variable and fix the remaining portion. By choosing to combine the fixed and variable component, you can take advantage of the flexibility offered by a variable rate and the certainty of repayments under the fixed component. Now, the big advantage of this type of product is that it allows you as a borrower to really minimize the risk in times of rising interest rates by having a proportion fixed. It does give you a blend of payment and flexibility assurance. The disadvantage is really the variable rate is still vulnerable to increases in rates if they do go up. Also, if they drop below the fixed rate, you will be required to make the repayments at the higher rate for the proportion of the loan. A line of credit is really a home equity loan, in that the line of credit is secured by a registered mortgage over a residential property. So they operate like an overdraft facility, and the funds can be drawn down from the facility and used for lifestyle or investment type purposes. When the loan is established, you can use the money by drawing down on it for really whatever purpose you may choose. Interest rates are also lower than other forms of credit, like a credit card, so they're probably the big advantages of having a line of credit. The disadvantage is probably also having that easy access to money, and the easy access to money for whatever purpose you so wish. But a maximum limit is established on the loan account, usually to an acceptable lending ratio. Debt is not reduced over time, which could leave you as a borrower with an ongoing commitment. Taking on a line of credit loan really means that you have to be disciplined and really strong with your budget. Low-doc loans are products that were originally designed for individuals that were in business and basically couldn't supply 2 years' worth of trading or financial results. So to be eligible for a loan-doc loan, an applicant had to supply an ABN and also a statement that their earnings were of a certain amount, or make a statutory declaration that they could really afford the loan. And they were available to both individuals and also companies. Now, no-doc loans to consumers are no longer possible due to the requirement of financial providers needing to make reasonable inquiries into the loan. So it is still possible if the income is verified by an accountant and signed off by them, indicating that they can afford the loan. Generally, there is a higher risk associated with this product, which does equate to a higher interest rate that will be charged. Construction loans. Now, these are the loans that have been designed for home builders. This type of loan basically allows you as a borrower to withdraw the funds in stages to pay tradespeople and suppliers. Interest is paid on the funds that are used. Most of these loans are offered at a variable rate. Once the construction has finished, the loan will then revert back to principal and interest repayments. Approval for these sorts of loans will require plans, permits, and also a fixed price building contract.